China was by far the biggest abuser in history, and others also, but somebody had to do it. They had to stop because it was not sustainable. I did a 90-day pause for the people that didn't retaliate, because I told them if you retaliate, we're going to double it. And that's what I did with China, because they did retaliate. So we'll see how it all works out. I think it's going to work out amazing. I think that our country is going to be at the end of a year or shorter, but I think we're going to have something that nobody would have dreamt possible. Someday you have to cut the bow, and you have to do what you have to do. The deal can be made with everyone.
Okay, so best behaviour, because I've actually just pressed record. We'll keep this rolling. There is so much uncertainty going on in the world at the moment. We've just heard the press conference that Your Honour did. And I will date stamp this episode. We're recording on the 10th of April on Thursday morning. This episode is going up on the 17th of April, so there's a week lag. But everything we're going to talk about today will still suit because it's zoom out, big picture. Okay. We've just heard Trump. People, they're getting a little bit yippy, a little bit afraid. How should Australians think about risk in their super given all this global uncertainty?
Oh, look, I think this is the kind of environment. I suppose the key messages we're trying to get across to members is that, any long-term investment journey, and super is the longest-term investment journey any of us are ever going to have, this kind of periods of volatility, whether they're triggered by economic events or geopolitical events or trade events or whatever, they are part and parcel of any long-term journey. And so this sort of volatility is inevitable. Certainly the period we're going through now, as far as trade and tariffs and what Trump is doing, is pretty extreme and pretty extraordinary. But I suppose the main message we try to get across is, look, every period of uncertainty, every period of volatility does come to an end. At some point, life and business and the economy moves on and the markets move on. We can't try and predict in advance exactly how these events are going to evolve. We can't manage money that way. What we can do is try and take advantage of market volatility when it does arise, and certainly there's been plenty of opportunity to take advantage of this volatility in the last little while, but also to make sure we're building portfolios that are very much focused on delivering the returns members need for the longer term. That's really our prime focus.
So, as I said, I want this to be a high-level education episode because whether it is craziness coming out of the White House, a pandemic, a global financial crisis, what was before that, dot-com boom, these are things that create uncertainty.
Absolutely. And look, the world is always an inherently uncertain place. I mean, you can't hope to reliably forecast how these things are going to evolve. And I think that's another key message we try and get across. We often get asked by members, well, why didn't you see this coming? It's like, well...
And they're legitimate questions, aren't they?
Fair questions. Yeah. And when you look at the way the world evolves, it's impossible to forecast these things in advance. Especially short-term economic and market forecasting is, on a good day, it's a mug's game. And one of the dangerous things is that even if you do make a really good short-term forecast and you decide to move a portfolio one way and it actually works, now how much of that was genuine skill and how much of it was dumb luck? Who knows? We just don't think we can reliably generate returns that way. We're far better positioned if we just focus on the longer term, manage risk on behalf of our members, deliver the kind of long-term returns that our members need, and take advantage of these sort of volatility events. Because one of the phrases we've used on a recent podcast is this idea that, look, the share market has been on sale, that you've been actually able to buy quality companies at beaten down prices. We've not been panicking, we've not been selling, we've been buying. Yeah. And certainly, as of today's date, we've benefited from that buying. But this doesn't mean we're out of the woods. I think we're in for more global uncertainty, more geopolitical uncertainty and trade uncertainty for some time. Look, eventually markets do move on and we will see a genuine recovery, but I just think the short term is going to remain pretty volatile.
And when we think about it, we don't want to invest in growth assets or, from maybe a balanced super portfolio, a growth or higher growth for a period of less than 5 to 10 to 12 years. Now, I'm going out on a limb to say, hey kids, the next 4 years will be uncertain, particularly in this
Absolutely.
window of craziness. Because
Absolutely,
we've
yeah.
seen a guy in the White House basically have the world as the kitten and he's got the dangly ball and he's just showing everyone he's got the power.
Yeah.
It's all wild. So having said all that, I just talked about growth assets. Are defensive assets becoming more important as, because what's going to happen? The markets are saying interest rates will shift. So talk to us about defensive assets in portfolios.
There's several things. Firstly, the traditional defensive assets. So these are things like cash, term deposits, government bonds, Australian and international bonds. I mean, generally speaking, in a portfolio, these assets are meant to provide you with a reliable income, but also capital protection. And generally speaking, when you go through these really challenging events in share markets, that's when your defensive assets kick in and provide you some protection. And you've seen some of that recently. And so it's a reminder that as part of a diversified investment strategy, you need to have some defence built into your portfolio. How much defence depends on how much risk you're prepared to take, what stage of life you're at, how much volatility you're prepared to accept. But generally speaking, you want to have at least some defensive characteristics in a portfolio. The good news out of the last few years, because you've seen interest rates rise, because you've seen the yield available on government bonds rise, and that's become about because bond prices have fallen. Now, actually, defensive assets look more attractive than they did. Because you recall coming out of COVID, when we saw cash rates in Australia cut to close to zero, you saw interest rates internationally fall to ridiculously low levels. It meant that, if I was getting very, very low returns on my cash and defensive assets. Now, I can actually get a reasonable return by allocating a portion of my portfolio to these defensive assets. And in this kind of environment, it's a reminder that sometimes having that defensive exposure is useful. It's all about diversification, lots of eggs in lots of different baskets.
And I guess with the ordinary course of portfolios, portfolios will have a target that we want a band, a percentage band. There'll be this percent in Australian equities. It might be 25 to 35 at any one time.
Yeah.
Does your team, when you manage portfolios, given that the product disclosure statement or the rules that you say that we run the portfolio by, would your team hold off a rebalance if it is so uncertain at the moment and just wait 10 minutes? Like, what are you guys doing there?
Generally speaking, there's probably two aspects to this.
Yeah.
One is we're rebalancing portfolios very regularly.
Yeah.
So generally speaking, we take advantage of there should be some what we call a rebalancing premium. If you're rebalancing the portfolio regularly, it means you kind of get an opportunity to buy low and sell high on a regular basis. So we do rebalance the portfolio, but the other thing we do is take advantage of market volatility through what we call dynamic asset allocation.
Yes.
And so, for example, going into this most recent period of volatility, we were basically positioned a little bit defensively. We were a little bit underweight shares and a bit overweight bonds. And then you saw shares sell off dramatically and bonds performed really, really well. So we unwound that. We did some buying. Now, that's proven to be quite profitable. So we do take advantage of that market volatility when it arises. We're not trying to hit every ball for six.
No.
Primarily what we're trying to do is two things. One is make sure that we're delivering what's on the box. If we tell our members we're aiming for an average return over the next decade of X, we've got to hit X and preferably beat it. But what we're also doing is try to add a bit of incremental value around the edges. And these sort of volatile times kind of give us the opportunity to do that.
Yeah, well, there you go. Hey everyone, welcome to the podcast. Today we are joined by Brian Parker, the Chief Economist of Australian Retirement Trust. Welcome back to the studio.
Great to be here, Glenn.
So this episode is brought to you by Australian Retirement Trust. Thank you so much for partnering with our podcast to help educate our listeners
You're most welcome, sir.
Probably up there with maybe their biggest asset outside of their home.
Yeah, I think that's the thing, is that this is for a lot of people, this will be the biggest single asset they have. And it's certainly the longest term asset they're going to have.
Yeah.
And it's important. And I think more and more people are starting to, hopefully more and more people will start to pay attention to how much they've got, how much they need, how their super is invested, and understand how it's invested. I think that's really, really important.
Awesome. Well, let's do a podcast.
Let's crack on.
This episode is brought to you by Australian Retirement Trust. It's the super fund with the big blue monster, focused on awakening super for over 2.5 million Australians. Could you be sitting on a monster? Consider the PDS and T&D before deciding at art.com.au. You're listening to Money, 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 or as the regulars like to call it, M3. We're Australia's OG personal finance podcast. Everything you hear on the show is general advice only, which I'm licensed to give, and details can be found in the show notes. My name's Glen James, former financial advisor, now podcaster. I've got a book, The Quick Start Guide to Investing, and I host, produce, and curate this podcast with you in mind. You can follow me on Instagram, just search Money Podcast, or if you want to join the Facebook group, just put this episode number on your way in so we know you're real and not spam. Otherwise, thanks so much for listening. Let's do this. Hey, before we get into the chat around, this trade war, the tariffs and all that stuff, remember, if you want to join the Facebook group, there is so much spam on Facebook. Just put, when you click join, how did you hear about this? Put the episode number. I heard it on episode 815B. We'll know you're not spam. So it has been, before we press record, I said there's been some good fodder to talk about in recent weeks and days and hours. Look, I want to start this whole big thing, tariffs and trade wars. Maybe we start with what exactly is a trade war? And how does sounds like an old word.
Well, I liked because I thought we kind of moved beyond trade wars and excessive levelling. Maybe we'll return to situation normal, but let's see how the world evolves. A tariff is basically a tax on imports, and it's paid by the importer. So if I import whatever from overseas, I have to pay a tariff to the government, and generally speaking, I'm going to pass on that tariff to my customers.
Well, I've been saying you've really got three.
Well, that's the thing, and tariffs are fundamentally paid by the customer. They're not paid by the President Trump
says they are,
which is not true. It simply isn't true. Basically, if the US imposes tariffs on imports, it's not the Mexicans or the Canadians or the Chinese that are paying the tariff. American businesses and American consumers will pay the tariff. And so it's a tax on imports. The aim is to try and reduce demand for imports and increase demand for your domestic suppliers. A trade war is essentially countries doing battle using the weapon of tariffs. So if I raise tariffs aggressively to try and hurt another country's trade, they respond by raising their tariffs. Does it work? Generally, it does more harm than good. Higher tariffs basically mean higher prices and lower growth. That's the bottom line.
So my little printout here that I did a reel on Instagram, if you want to follow us on Instagram, everyone, there was an existing 20% tariff on Chinese imports. I don't know whether it was some products or all products or whatever, we'll just call it 20%. Liberation Day happened, Brian. Yes. A day that we'll all remember. Where were you on Liberation Day? The US basically levied a further 34% on imports into the US from China, and that's a total 54% tariff. China then said, all right, we're going to do 34%. So stuff that's coming in on 34% from America to China. Trump on Wednesday the 9th, yesterday, said, all right, bro, we're now at 102% on Chinese imports. Yep. Which is this is just wild. Yep. Then overnight, because China have said we're an immovable object and Trump is saying he's an unstoppable force. What happens when those two collide? Well, the end of time.
Correct. It's not pretty at all. No.
So China said, okay, we're increasing it to 84% in a reply. It's an arms race of taxes and tariffs. And then overnight when the S&P 500 basically went up 9.5%, Trump said, well, China, we're at 125%. And he's ultimately said at the moment, we're pausing the reciprocal tariffs for 90 days and we're keeping a base 10% globally. And he's now saying we can negotiate with trade partners. I mean, talk about uncertainty.
Absolutely. And put it this way, are you going to have to? You're going to have to negotiate a whole bunch of separate agreements with theoretically 150 countries, but or more. You probably only have to negotiate with a relatively small subset of those, but it's still going to be a very long, difficult process. And in the meantime, it's just more frustration, more uncertainty, and a higher cost of doing business. It's certainly no way to run a country and no way to run a government. But this is where we are. I think. We really just don't know how this is going to evolve. Unless you can get inside the head of the President of the United States, then you really don't know how this is going to evolve.
Yeah.
But one thing we do know is that the trade wars work. No, they don't. They tend to be very destructive to the global economy, not just to global trade, but to the economy. They impose costs on business and consumers. So they tend to not work.
Yeah.
Trade wars have a habit of leading to something worse. To the extent that trade wars are a measure or an indicator of underlying tensions between different countries, who knows where that leads to. So this is no way to really run the global economy.
Yeah. And given the last 24 hours at the time of recording, when this episode goes up on Thursday, the 18th of April,
who knows what could be.
These numbers might mean nothing.
Correct.
And that's why I just want people to understand the principles and the concepts. Why does China matter so much to the globe and particularly Australia?
A few things there. Look, firstly, China is currently the second largest economy in the world, and it certainly has been responsible for a massive share of the world's overall growth.
Well, it's the world's factory.
Well, pretty much it has been.
Yeah.
But its economies continue to develop. It certainly has seen somewhat slower growth in the last few years, aging population, slower productivity growth. But certainly it has been responsible for a massive chunk of the world's growth. It's the second largest economy in the world. For Australia, it's been a key export destination. We have basically provided the commodities which have helped construct the modern Chinese economy. China is currently our largest trading partner and is likely to remain so for quite some time. We've been a key beneficiary from China's rise. We've actually had to steer a fairly careful course between acknowledging that we have disputes with China over the last few years. We know that. We're still, the US has been our key defense ally for decades. And so any tension between the US and China, whether it's trade or otherwise, we're kind of meat in the sandwich there a little bit.
It's probably important to call out what the US or Trump is doing to China effectively is what China did to Australia in relation to the wine exports.
Yes, although the interesting thing with that is, China's measures that they imposed on Australia, they were certainly carefully crafted in the sense that
was that a political response to the government at the day being dirty on China?
You know what? I think it was actually, to be honest, it sounded a bit petulant on China's part.
Yeah,
really.
That's what I kind of
thought. But
it
was sort of a signal. It was saying, look, at the end of the day, don't take us on. We're going to impose some restrictions on bits of your trade that actually aren't going to be a killer punch for your economy. They're going to be a damn nuisance. But we're going to impose measures on particular items that are a nuisance to you and have no strategic value to us.
And I think it's like when you have such a powerful country and even personality, there's that ego where you want to say to people, I need to remind you who's in control.
That's pretty much what the signal it gave. And it wasn't just Australia. Australia was kind of used as a bit of a signalling tool there because while they were imposing annoying trade measures on us, we were able in a number of cases, to redirect those exports somewhere else. But also it was a signal to the rest of the region saying, don't take us on because look at what's happened to Australia's trade. So it was a signal not just to Australia but to the wider region that they are the 800-pound gorilla in the Asia-Pacific region. And so in that sense it was a signalling tool not just to Australia but to the rest of the world. It wasn't helpful and those measures have now largely gone away, which is terrific. But I think there's a greater problem at work here. Trump looks at trade in a very, very simplistic way. He is largely wrong about trade. This idea that if the US is running a trade deficit with a particular country, that country must be ripping the US off is just a myth.
It was funny. I saw an Economist Instagram reel and it was a really good example. There was a country in Africa that supplied diamonds to the US, and there's, of course, going to be a trade deficit.
Yes.
Because they're not going to ever buy more from the US, being a small nation,
Correct.
than the US buying the odd diamond. And I think the guy was like, it's like if you walk past the jewelry store and they're upset at you for not buying a diamond.
Yeah, that's pretty much it. A lot of these trade measures, a lot of the views about trade that come out of the White House are just, frankly, just nonsense. Let's be honest about this. This idea that you can eliminate trade deficits with every individual country is just a nonsense. Trade deficits are determined by a whole range of different things. And this idea that you can micromanage your trade deficit at the country level is just quite silly. And one of the analogies I saw on social media was it's sort of like saying to Coles or Woolworths, look, I'm going to steal some fruit off you because I have a trade deficit with you because you don't buy anything off me, but I buy stuff off you. So I'm going to steal stuff. It's like, let's see how long that lasts. So again, a lot of this stuff is real nonsense. The world realised over the last 100 and something years that gradually lowering tariffs and doing business internationally was more efficient. It made for a more productive world. It raised the living standards of everybody, some countries more than others. But this idea that the US has been pillaged by other countries for so many years is just a myth. The US has benefited from a relatively stable, relatively free trading economy around the world. The US has been a beneficiary of this. That's not to say there aren't particular sectors or particular workers that lose out from trade from time to time. That's inevitable as well. But generally speaking, the whole world is better off from having relatively free trade.
Yeah. Hey, we talked about, that trade deficit.
Yeah.
I think the scandal for Australia, and even there was a senator just a couple of days ago grilling one of the Trump people or whatever. Australia has a trade surplus with the US.
Yes.
What does that mean?
It means that we basically buy more from the United States than they buy from us. And
so based on that, the what's the word? The vibe, or what's the word? Like
I think
the basis of these tariffs imposing because of trade deficits on these countries, it actually is just rubbish given that they've put a tariff on Australia.
Yeah, that's right. And I think one of the other sort of silly arguments you've heard, Australia sells us beef, but they don't buy any of our beef. It's like, why would we buy your beef when we have a surplus of our own beef?
And yours is rubbish. It's full of
we're not
mad
forcing
cow.
you to buy. We're not forcing you to buy our beef, but somehow you do. Well, why is that our problem? The other myth out there that's been peddled by some people in the US administration is that they look at Australia's GST, which is a value-added tax, and say, well, you're imposing a tax. It's like a tariff. It's like, no, it's not. The tax is imposed on any goods and services sold in Australia, whether they're imported or whether they're locally produced. So it's not the same thing. This idea that they look at the GST and say, you're imposing a tax on our exports to you, and they're basically saying it's kind of like a tariff. That's a myth as well. It's yet another bit of nonsense that has come out in this debate.
Yeah.
I also think that when you think about the tariff measures, if you're worried, if you fundamentally believe that you need to take on China and you're using tariffs as a signal to do that, it would be nice if you actually presented a united front to balance out China alongside your allies. But if you're
also some logic in your rationale.
Correct. But also, if you think about the geopolitical implications of what Trump previously announced and is now suspended, he's whacked, 25% tariff, 24% tariff, for example, on Japan.
Yeah.
It's absolutely key Pacific ally. Why would you do that? To impose these tariffs on countries whose support you probably will need at some point. And the other thing is that China has certainly been trying to raise its influence in the South Pacific, in the rest of Asia, but also in Africa. So there has been a competition for influence, if you like, between the United States and the West and China in these emerging economies. Now, if you want to actually force some of these countries further into the arms of China, you seem to be going the right way about it.
Yeah, that's
because
right.
how can you then these countries would look at the United States and say, well, we thought you were kind of a reliable partner. How can we treat you as a reliable partner if this is how you're going to treat us and how you're going to treat some of your closest allies? The damage to trust this does, trust in the United States as a massive power that essentially tries to do the right thing, even if sometimes they don't. I just think that trust has been damaged for how long, I don't know.
Yeah. Hey, when Elon basically, what do they call it? The first bro of the USA. Like I've been saying for a few weeks, how long will it last with Elon on his lap? I don't think it's going to be too long. We know a couple of things. Peter Navarro, who's basically Donald Trump tariff advisor, he's basically in a fight with Elon at the moment.
Yep.
Who actually, fun fact, get this, I've heard on good authority that Elon Musk is the next Bond villain. That's a lie, everyone. That's fake news.
It's fake news.
But and someone said just the other day, and this is why I think the rift with Elon and Trump will actually break.
Yes.
Is someone said Tesla, they're not an American car manufacturer, they're an American car assembler because a lot of the products are coming from overseas.
Well, certainly, this is the thing. The car industry has been globalized for years. Is there any such thing as a truly American car or a truly Japanese car? Because a lot of these manufacturers source parts from all over the place. That supply chains have been globally integrated for decades.
Yeah.
And this idea that, imposing a tariff, because you want to protect American car makers or defend against Chinese imports or whatever, it's a failure to understand how globalized supply chains are. I just don't think the US administration truly understands how the global economy works.
Yeah.
And so they don't understand or they don't care
Or they
about the
do, and
disruption.
it's so calculated what they're doing.
I'd like
And
to think
that's scary.
if there is a grand plan and a grand strategy, it's not a very smart one. To call it a strategy probably overstates the sophistication of it. It's actually very simplistic, very damaging, and I do think it has a lot of people scratching their heads about, does Trump really know what he's doing? I suspect he doesn't.
Okay, so back to kind of your wheelhouse, and I know you can't speak on behalf of any other super funds, and I'm okay if you speak to your portfolios. Global markets and super funds.
Yep.
Most of us who have a super fund have an allocation to international equities, US, Europe, and whatnot. Are there certain sectors within that are hit harder by trade tensions? And how does basically what's going on at the moment particularly impact that portion of global exposure in the super fund? And I think I'm just going to throw a heap of stuff out and you can take it wherever you want.
Okay.
Because we need to understand that within a super fund portfolio, it is a balanced portfolio. We're going to have Australian shares, US shares.
Yes.
We're going to have unlisted
European,
property.
Japanese shares.
We're going to have alternative
Correct.
assets. There might be a bit of gold. There might be
A whole
a
range
variety
of
of things.
different
So
things,
how, I don't know, if you want to just take it anywhere from there, like global markets, super funds, and I know you can speak on behalf of Australian Retirement Trust, but what's the impact?
Okay. Firstly, trade wars are bad for growth, and if they're bad for growth, it means it's bad for company profits, which in turn is bad for share prices, if I can put it simply. And so consequently, which is why share markets have responded so badly to the imposition of tariffs, because it's fundamentally bad for growth and bad for business. That said, there are clearly some markets that are going to be more severely affected than others. So to the extent that and this does vary on a daily basis, but if you're an economy that is very, very heavily dependent on international trade, then you're probably going to suffer more, and maybe your share prices will get more hurt as a result. At the company level, companies that are mainly focused on servicing their domestic market should actually hold up maybe a bit better. To the extent that your costs or your sales are going to be more damaged because of the tariffs, clearly your performance is going to be more severely affected. Initially, share markets, when they get a shock like this, there's this initial panic, if you like, and then maybe after a while markets become a bit more discerning and identify which companies and which sectors are going to be more hard hit than others. But as a general statement, share markets have responded the way they have, because tariffs are bad for growth and bad for profits. Now, the other story here is a diversification.
And just on that, the sudden swings that we've been seeing, I think last week, or there was a rumor that tariffs were going to be off. Market shot up in one day. Oh no, not a rumor. Went back down.
Yes.
2 days later.
The trading the other day was so
like,
volatile. The trading the other day was so volatile because any hint the tariffs might come off, you saw the response, and then it was like, no, they're not coming off, and the market tanked again. The other story here is diversification. So while share markets have been hurt by the damage the tariffs could potentially do to economic growth and to profits, bonds have actually held up reasonably well because, generally speaking, if the economy is going to be weaker, it means the central banks may actually cut interest rates a bit further, and that's generally supported bonds. So bonds have done very well. But the other story here is the private assets. So Australian superannuation funds in general, and ART in particular, we tend to run about 30% of our portfolio in what we call unlisted or private assets.
So they're not going to get the volatility.
Not the same volatility, no. And again, a lot of these assets.
Can you give an example of one of those assets?
Yeah, so things like, for example, in real estate, it could be things like aged care facilities here in Australia and the UK. It could be commercial office buildings, which are clearly going to be impacted by a downturn in the economy if that were to happen. But things like holiday parks. So we invest in the G'day Group, which is Australia's probably largest holiday park operator. We invest in things like industrial properties, so just big tin sheds that store stuff and distribute stuff. That's going to have some economic exposure. But generally speaking, a lot of these assets, we revalue them progressively through the year, both up and down as required. But generally speaking, when share markets are running hot, they don't tend to do quite as well as share markets do. But the flip side of that is when you go through periods of very bad volatility in share markets, they tend to hold their value to a greater extent.
So you really don't want all the pieces of the portfolio pie to correlate?
No, ideally you want a bunch of assets that actually are more often than not uncorrelated or negatively correlated, so that if share markets do badly, you want something that's going to be doing well.
Yeah.
Bonds have traditionally done that. Not always, though, but bonds are part of that story. But the private assets are another part of the story. Any assets that we can include that by their very nature deliver a return but are capable of delivering a return that isn't dependent on what's happening in the stock market, that's a better story. It means that I can help smooth the ride for members along the way. The other story there is private equity. So in addition to investing in companies that
I
are
like
listed,
when you talk dirty to me, Brian.
Oh my God, you nearly sounded like Donald Trump then. A bearded Donald Trump. It was
Don't
quite
get
eerie.
yippee.
Don't get yippee on me.
Don't get afraid.
Don't get afraid. I'm just going to post tariffs. I'm Mr. Tariff Man. But basically, private equity is investing in businesses, often small to medium businesses, that are not listed on the stock market.
Invest in mine.
But the other story there is private equity investments are going to be impacted.
Yeah.
So,
Why?
Well, at the end of the day, they're companies, and if the stock market is telling you that a whole bunch of companies are now worth less than they were a few months ago, and if you've got a portfolio of private companies, well, you can't say, but my companies are fine, because maybe some of those companies are going to be impacted by the same growth outlook pressures or tariff pressures or whatever that the listed markets are.
And I think it's important to note, just from a real basic, I don't know the number off the top of my head, but private companies, unlisted companies, small businesses, right? I'll give an example. Like, I run a small business.
Yep.
There's 5 team members. And with all the uncertainty going on, as a small business, do I feel like taking some risks, using some of the cash I've got to invest for the future? Hell no. Do I feel like employing new staff members to grow the business? Hell no. Too much uncertainty. Businesses need regulatory certainty.
Correct. Exactly.
We need certainty in markets. We need certainty from the RBA. Actually, a question, I did a YouTube live the other night and someone asked me a question that I didn't know the answer to. And I'm going to ask you right after the break.
I might know the answer.
Yeah, well, that's right.
Well, let's give it a try anyway.
Let's give it a try. We'll be back right after this. Before we get back into the show, I'd like to encourage you to protect your financial life. Now, what does that mean? It means having income protection insurance in place. It means having death cover in place if you do have debt or dependents. It means having your suite of personal insurances sorted. I know you insure your car. I know you insure your house. Why not insure you? I really want to encourage you to reach out to Sky Wealth. They support the podcast. They are specialist financial advisors who can look at your situation, walk through a heap of options personalized to you. It's usually far more comprehensive and competitively priced than going direct to your super fund. You must see a specialist financial advisor for your insurance. You can head to sky.com.au, that's skye.com.au, to book a complimentary 15-minute chat and the team can point you in the right direction. Like all good cults, we need a place to hang out together. That's our Facebook group. If you are going to join the Money, Money, Money podcast Facebook group, just put you heard about the group through the podcast and put this episode number that you're listening to. That way we know that you're not a spam account. Otherwise, you can catch me on Instagram at moneypodcast.aus. Thanks so much for listening. Thanks to Sky Wealth. Let's get back into the show. Someone asked me, and I did not know the answer to this. Might be because I'm still young, Brian. I'm hip. I'm like,
really? Is that really the hill you want to die on?
No,
Seriously?
no.
Probably not. No.
They said, given all the uncertainty that's out there at the moment, and my rant before about, if things are uncertain with businesses, I'm not going to want to grow.
That's it.
Which means, why would people want to invest in me if I've got no plans to grow and there's uncertainty, right?
Yeah.
I want to hoard cash for now. I don't want to put on new staff. It's a spending freeze, all that stuff. So that flows through to the private equity stuff that you're talking about.
Absolutely. It's what John Maynard Keynes, the economist, called animal spirits, basically, and that business is a confidence game. If you're not feeling confident, you're not going to invest as much. You're going to bide your time. And look, the world is inherently uncertain. We can't know the future with any certainty. But it's about managing that uncertainty and actually, and accepting that the world is an uncertain place and being prepared to take the risk. But in periods like this, that risk does look too great for a lot of people.
So the question that someone said on the YouTube live, given all the uncertainty that's happened at the moment, will the RBA in Australia, the board, Reserve Bank of Australia, call an emergency meeting? And I'm like, oh, far out. I'm not a freaking economist, but I'm like, well, I don't think so because this is just day on day crazy volatility.
Yeah, exactly.
And the Reserve Bank, they want stability. So how would you answer that question? Would the RBA ever call an emergency meeting?
Look, theoretically they could.
They could, okay.
Theoretically, they could get the board on a conference call and say, we need to do this because of this particular emergency, and they could theoretically do
it
that.
overnight.
Yes, but that's they could theoretically.
So they could theoretically call an emergency meeting overnight, change the monetary
policy could change
up or down overnight.
You could do, and you could take the decision, and you could get the trading desk, the money market desk at the Reserve Bank to execute the next day.
Okay, cool.
Yeah.
Okay, cool.
But your point, I think the important point there is that would be a fairly drastic step.
Yeah, I don't think we're
in that environment. No. I mean, if you were to, and if you take a step like that, the situation would need to be really dire to justify that, because otherwise you're going to actually compound the problem. If the Reserve Bank or any central bank takes that step, it needs to be a massive emergency, so that people will look at what you're doing and saying, okay, you're actually helping us.
Yeah.
But if they were to take a step like that in this kind of environment, it may actually be counterproductive. It may actually make people even more worried.
That's right, yeah.
And so I don't see that happening.
I mean, the last big emergency I can remember was GFC. I think one of the top 5 banks had a week of liquidity to go, and that's when Rudd stepped in and said, there's a guarantee of $250K. Don't Like
That's right. Yeah, they had to take
it's
some
more the
drastic
governments
steps.
would probably step in faster than the Reserve Bank. Yeah.
Yeah, but yeah, central banks certainly can act between meetings, if you like, but it would need to be pretty dire for them to do that.
Yeah,
They'd
awesome.
much rather stick to the regular meeting cycle.
Okay, so finally, I'm going to throw a couple of questions and comments out again. This is my style of kind of interviewing. I just kind of throw all my thoughts out, all my questions onto the table.
Fire away.
You can pick that dead carcass like a crow if you want, whatever you want. Right now with our super, what do? Should we worry? Or do we pay our fund managers to worry for us? Like, what are we doing right now? Because super isn't an asset. I was thinking this yesterday, Brian. Super isn't an asset for retirement, quote unquote. Super is a wealth asset as long as we're living. It's a life asset where we can just start to access it at retirement.
I think there you go. Okay, the way I would think about super is, look, super is the longest term investment any of us are ever going to have, really. Okay, and it's important that how your super is invested should reflect your stage of life, your financial goals, your financial needs, and your appetite for risk. Now, when you go through periods of volatility like this, and you say, well, why should I stay invested when I have to put up with this stress every so often? And my answer to that has always been, why would you put up with this level of volatility? You put up with this level of volatility because the reward you get is a better long-term result. In other words, you get rewarded for risk.
Yeah.
And not always, but over the longer term, you get rewarded based on how much risk you're prepared to take. Now, that said, does this mean we should all just pile in and buy equities until they're coming out our ears? The other story I like to tell people is the sleep at night test, is that you need to take as much risk as you're comfortable with to get a higher return, but not so much risk that you're losing sleep at night. And it's almost like, look, if you're losing more than about 2 minutes of sleep at night because of something you're doing with money, whether it's your super, your small business, or your mortgage or whatever, it's like your body telling you something. Your body is telling you you're taking too much risk.
Yeah.
And so there's a trade-off there.
But also, I think that's a good point, but you can actually lean into that. One way to reduce that inherent feeling of risk is education.
Correct. Absolutely.
And, plugging my laptop back in. And I think what I'd probably say to people is we probably don't need to look at our super balance every day.
Nope.
Why are we looking at something we can't touch for 20, 30, 40 years?
I think that's a good point.
Check it every 6 months if you want.
Absolutely, and I mean one of the I suppose ironic things is that given the advances in technology and given we have an app, for example, where you can do a lot of things with your superannuation portfolio with ART, and also other providers have a similar app, where you can do so much on your phone. Now, that's both good and bad. Maybe it encourages people to actually look too often because they can. It's in their hand. It's in their pocket. Because I often think that when it comes to super, sometimes benign neglect is a good strategy.
Yeah.
If you just ignore it and just have a look at it every few months or have a look at it once a year, because the last thing you want is to be looking at it every minute of the day and potentially panicking about it and responding. It leads potentially for people to make really poor snap judgments and make major financial mistakes like, oh no, the market's down 10%, I'm panicking, I'm selling. And all you've done then is just lock in a loss.
But if the market is down 10%, you open the super fund the next day, your fund won't be down 10% because it's not all in that market.
Correct,
that fell
exactly,
10%.
Yeah.
And I would say for those who are struggling with this, what I want you to do is look at your super fund. It's a unitized fund, right?
Yes.
So someone logs into ART, their account, it says balanced portfolio, growth portfolio. It'll tell them how many units they hold, I think.
Yep. Oh, well, we just put the dollar value.
Yeah.
So you see, this is how much money you've got.
Yeah. And your goal is to buy as many units in that fund as possible.
Yes.
That's the goal.
That's it. It's like the price of these units goes up and down.
Yeah, but just have as many units as possible.
That's right, because and especially during a period like this, and when you look at what professional investors do during a period like this, professional investors are actually not panicking and selling. They generally look for opportunities to buy. when other people are panicking, it's our job to look for opportunities,
Yep.
and that's exactly
Yep.
what we do. And telling members that when people say, "Well, should I be becoming more defensive?" It's part of our education challenge, and this is why podcasts like yours are so valuable. Is that educating people and telling them, "Well, look, this is part and parcel of long-term investing." You'll inevitably go through periods of where markets are challenged, where share prices are falling.
And as your employer contributions are going in, they're buying cheaper units
correct,
anyway.
Exactly. And so it means that all your regular contributions are now taking advantage of this market volatility without you having to do a damn thing.
Awesome.
I think that's a really important point.
So what should we do? Probably nothing. Should we worry? Probably not.
I think that's the thing.
Why do we even do this episode today?
Well, hopefully so people don't need to worry so much. Look, if you are losing sleep at night, we would encourage people, firstly, if you have your own financial advisor, get on the blower and have a chat to them. If you don't have a financial advisor, talk to your super fund.
Yeah.
And they can provide some limited advice, but they can also refer you to a financial advisor if you need more complicated needs.
Yeah.
This is where financial advice is really powerful because it stops people from making really poor investment choices at a really bad time.
It's funny. I was, and we do have to finish, but I was saying to someone the other day, and I think I even said it on a podcast. I'm like, people freak out, particularly, with the Retire Right podcast for the over 55s.
Yep.
To get financial advice at the moment in Australia in this climate, it could cost the minimum of $5,000, right? However, the question isn't, well, if I pay $5,000, will I get $10,000 back? No. We're paying that money to an advisor to make sure we don't do something dumb that will cost us $20,000, $30,000, $40,000, $50,000. We're paying for advice so we don't make a strategic mistake that could cost us thousands and thousands of dollars.
I think that's right. I remember speaking to a financial advisor some years ago in Perth who basically said, my job is to hold people's hand.
Yeah.
I'm a professional hand holder. I hold people's hand through life so they don't do dumb things with money.
Yeah.
And I think that's a really powerful way to think about it.
Well, Brian, we'll have to have you back maybe next
Be
quarter.
delighted.
We'll see what happens between then and now.
Who knows? Who knows what could be happening between now and then? But it's always good value to come on, Glenn. So thanks very much again for your time.
No worries. Thank you to Brian Parker from the Australian Retirement Trust. He's the chief economist. We'll put a link in the show notes to their website if you want to check out their stuff. My name's Glen James. This was Brian. You've been real. See you later. Thanks for listening to today's podcast. If you want to support us, there is one way you can do that. You can send the episode to a friend, a family member, or your group chat if you think those people would find it valuable. We also thank you for leaving a review on Apple or Spotify. If you've listened to this podcast for some time, or if you've read any of my books, you would know that giving and generosity in a financial sense is a big thing in my life. If you think it's time that you are ready to give financially to a good cause, you could head to our website, moneypodcast.com.au/charities to see the charities that we support.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds Financial Services Licence 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective licence holders.